You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If we sound a little bit different, it's because we're not coming to you from our studio in scenic and sunny Florida. We're actually coming to you from the Options Industry Conference here in sunny, actually, our studio in scenic Chicago. We're coming to you from sunny Florida right now, again, for the Options Industry Conference. It's a great event. We get to sit down with a variety of different people from throughout the world of options and proceed to pick their brains, which you know we like to do here on the show. And our next guest is an old friend of the show, even though he hasn't been on in a while. He is Kevin Kennedy, the Senior Vice President of U.S. Derivatives over there at NASDAQ. Kevin, welcome back to the program.
Thanks, Mark. It's great to be here. And you're right, we haven't spoken in a while, but I feel like in some ways that I was here a day ago. So
nothing's happened over the past year, right? Nothing. It's been a very quiet quiet year. Well, congrats on the upgraded title, even though from our perspective we like just options. But, adding in futures, we won't hold that against you, sir.
Good.
Well, let's kick things off. Last time you were on, about a year ago, all the talk, all the rage was the new Philly floor. You got a year under your belt now, or close to it. How are things going over there in Philly land with the new trading floor?
It's going well, and I was just giving an internal update on, the floor brokers are a funny sort. They have
that's putting it mildly.
Yes, they have great passion for their business, and we gave them a great landscape of Philadelphia, and all they were worried about was, will our phones work? So they lived in a dungeon for 30-some years, and we let them out. And they're doing great work, but it was all about just make sure my phones work so I can speak with my clients, and they're working. But it's a nice venue, and it's great.
Paint a picture of that venue for our listeners who maybe obviously haven't been to Philly, haven't seen it. What are you talking about in terms of how many products and how many crowds, crowd size? What's going on down there?
Okay, so I'll paint a picture of what it used to be to start, which is the basement of a building that was built in 1982, and no windows, no external windows at all, very dark. Very rubber floors, a lot of CRT monitors, just the monochrome, black and white monitors, and dark. Now you go to the 8th floor in what we call the K Zone in Philadelphia near 30th Street Station, an up-and-coming area, and you go up to the 8th floor and you see panoramic views of the city of Philadelphia with Drexel University, the University of Pennsylvania. And you walk in, and it almost looks a little bit like a glorified TV studio. Wonderful space. You walk in, and you see first our group of market operations people, as well as surveillance. And then what we used to have maybe about 7 or 8 trading pits 10, 12 years ago, we've whittled down to 3. So there's space for 4 as we grow our proprietary products. Right now we're utilizing 3 pits. And in the center of those pits is really what looks like your 11 o'clock or 10 o'clock news studio, a curved piece of furniture where regulatory people, staff is centered there as well. So they are literally, overseeing every trade.
Surveillance, pretty much. It's like a casino.
It is like a casino, and it's great regulatory environment, and it is extremely efficient, and you can hear everything that's going on. There's a lot of competition. And it's working. It's a good workflow for high touch desks.
I think it would have been deeply unsettling if back in the dark days of the SIBO, if we had the market reg peering right over our shoulder.
But it's a different environment.
That's 2018 now. That's the world we live in these days. Interesting stuff. Speaking of the world and just in general, 2017. I think we joked last time you were on. Kind of the year of the resurgence of the trading floor in the options world. That was the trend. You guys, of course, Box. Some other people were talking about maybe getting their irons in that fire. So here we are. I don't know, not quite halfway, but pretty close to it through 2018. What do you think our 2018 trend of the year is so far from an options perspective?
So let me just touch first on 17. Let's reflect on that just for a second, and I think that'll help us, in my opinion, on 17 and my outlook. So 17 was a 40-year low in volatility, as you and I are both painfully aware, as ones who like to watch the market as former traders. But if you think about 2017 with a 40-year low in volatility, it was an exceptional year for the options industry in that we still actually grew multiply listed equity options volume year over year from 2016 to 17 by just about 2%. And if you had asked me at the end of 16 if realized volatility was going to be single digits, would we have an increase in volume? I would have bet anything that we would not, but we did. And we still did what we do well as an industry, which is enable the transfer of risk between parties and let participants take some risk to either leverage their portfolios or increase their yield, enhance their yield. So 2017 wound up being a pretty nice year all in all. And what we saw at the end of 17 was we started to see an increase in volume that was a little bit different than the first 9 or 10 months of 17. And that carried over into early January of 18. And I remember speaking with some clients and saying, what do you make of this increased volume? There's a January effect, which we've seen for years, but this seemed a little different. And it actually was foretelling of the volatility that was about to come. So I think the options volume, the increase in volume in early January, precipitated the correction that we then had at the end of January. And now we're doing 18 million equity options per day, a 29% increase over 2017's volume. Extremely optimistic. I am extremely optimistic, as I was even in the past, of how we look going forward. And I think, Mark, you and I have seen this, right? So it's a little bit like the real estate market, options volume. We grow, and then we're stable for a while, maybe a slight dip. And it's like a staircase. And then you're flat, and then with a little bit of good fortune, I think we're onto something big here, and I think we'll continue to see volume increase. Maybe not over the summer months, but I'm really looking forward to a good third and fourth quarter. Certainly the end of the third quarter, and I feel really good about the next few years.
It's funny you bring it up. What a difference a year does make. This conference last year was kind of like a funeral. Everyone was walking around there very depressed, head in their hands. You're right. Volume was down. Volatility was non-existent and on the way to becoming even more non-existent. So you're right. And that the recipe did not bode well for a strong year from a volume perspective. A lot of people were concerned about, where's retail volume gone. It was a pretty negative theme, I thought, to last year. Just talking to people at the event, I didn't see many people who were very upbeat on the prospects for the year. And now fast forward a year, and we're in a completely different environment. As you mentioned, volatility came roaring back with a gusto. Volume came roaring back with a gusto. As you mentioned, we're up, astronomically over this time last year, close to 30%. That's probably going to be difficult to maintain, but I'm curious. It sounds like you're pretty optimistic for the rest of the year. You think we'll be somewhere in that, I don't know, maybe 10 or 15% growth, 5%? What's your feeling for the rest of this year from a volume perspective?
I do. I think you're spot on. I think 5 to 10% growth is what I would look for in the remaining 8 months that we have left. And I'll take that. I mean, I think that's a good story, and I think if we continue to move the industry forward, of which this conference, has really been vital over the years in helping us move forward, not really take any steps backwards. It's been a quiet year, but we've done some nice things in the industry, and I think that those things put ourselves in a position to do well when volatility does come back, and we're starting to see it. So if you think back to 2008, 9, and 10, I think the industry handled the crisis back then really well, and I think we have much work to do, so we can't get complacent. But I'm looking forward to some of these panels addressing some of our risk items like risk-weighted assets and margin calculations for liquidity providers, because we can't lose sight of how important liquidity is to our industry. We have exceptional liquidity, but we need to make sure that we maintain that, or we could take a step backward.
It's funny you should bring that up, because on the way down here to the conference, we like to ask questions of our audience all the time, kind of get the pulse of what they're interested in. On the way down here, we said to them, it's our chance every year, OIC 2018, to catch up with everybody in the world of options. What do you think should be on the top of our agenda? We asked them for 2018. We gave them a few different choices, asked them to come back with theirs. We gave them options liquidity issues. We gave them, for fun, listing crypto options. I thought they would run away with it. So far, not so much. And we also gave them after-hours trading for options. We gave them a chance to respond. They've been responding with a whole bunch of interesting and esoteric suggestions. I won't bore you with those right now. But it is interesting. As of right now, we still have a couple days left in the poll. 44% are responding, saying options liquidity issue should be our number one concern here at the conference. And, we see it every year. Henry does his spiel here, and he talks about, what the ecosystem is like. And usually, I think last year it was down to about 19 names that were generating about half of the volume. I haven't had a chance to talk to Henry yet. Maybe that number is even lower. Maybe it's 17 or 18. I don't know. But the trend is clearly in the wrong direction. This has obviously gotten some mainstream traction lately. I think the Journal had a big piece about it recently, so it's got kind of top of mind for a lot of people. What do you think we could do as an industry collectively to try to bolster that, or maybe even reverse that trend, get it up to be 25, 50 names that are doing half the volume again? How do we get people, and more importantly, the markets maybe a little bit tighter in some of these beyond the Apples and the Facebooks of the world?
Sure. So I think volatility helps to start, and then I think at some point it's a little bit like the narrative I just gave you on being prepared for volatility. Like, I don't know that I can make Home Depot, just to pull a stock out of thin air, more volatile or more interesting tomorrow than it is today. But I think what we need to do is when a single stock is not really generating much interest because it's not their earnings season or the stock just hasn't been that volatile, we need to make sure that our market makers, our liquidity providers especially, are not taking too much risk, not paying too much margin for existing positions because they're short a $5 call spread at $4.90 and they're paying a huge margin amount on that. So we need to make sure that their allocation of capital is in the right spots and that they're being treated fairly. And if we do that, then I think what you'll see is, again, putting yourself in a position to win. So here's a great example. So we saw that Facebook came out with some news yesterday on dating sites. And Match.com, which trades about 3,200 options year to date per day, jumped up to in the 30,000s. And I took a hard look at that of the liquidity yesterday. And this is something I said on the panel last year, that our exceptional liquidity truly is exceptional. And if there's opportunity, we immediately, as an industry, show a ton of liquidity. So I looked at every strike, and it went out months and years, and every market was very respectable. 60 cents at 85, $1.10 at $1.30. This is with volatility spiking 2 to 3 times. Stock, I believe, was down $7 or $8, maybe 20-some%. And the ability to handle 3,200 options and turn it into 33,000 options on the spur of the moment is a great compliment to our industry. But it's something that I think tells the story that we were in a position to take advantage of it. And I think so. In answer to your original question, can we do to make sure that we kind of drop out of that top 19 being 90% or 80% of the volume? I think some of it's out of our hands, but let's be in a position to capitalize when it does happen. So Match.com was just one example. Maybe we need to do a deeper dive and say, okay, Kevin mentioned Match.com, but you know what? There was something else that got busy and we didn't show up with the liquidity. So I would say let's take a look at spikes in volatility and implied volatility and then see how the liquidity fared there and make sure we're putting ourselves as an industry in a position to win and provide the good liquidity.
It's the other kind of side of the liquidity coin, obviously, as you mentioned it, is the market makers. And that's another graph that the trajectory has kind of been, in terms of volume and number of market makers that are out there, has been going down for quite some time. You mentioned the capital issues. That's clearly a big concern for that industry. That stuff needs to be straightened out. The notion that, you're spending, as you mentioned, your $5 call spread example is a good one. You're reserving all this capital for a spread that has a nominal risk. It is absurd, and that needs to be taken care of. Outside of that, though, which is a big issue. What else can we do as an industry to really try to reverse the mass diaspora of people leaving the liquidity business and maybe get some firms coming in for a change?
Well, I think we need to pay close attention to continued fragmentation, of which you could argue to some degree that we're a part of with 6 options exchanges.
You do have a few under your belt.
Yes, and it's important to note that they came with the territory. We didn't go out and file for number 5 and number 6. They came with the ISE purchase. We do believe they add some value. We're in constant dialogue with not just our clients, but also with the options committees like STA and SIFMA to talk about how we can be good stewards of those SROs. They're providing a sort of a broad reach for certain market makers who you alluded to, maybe some are coming, some are going, but they can become specialists or LMMs or PMMs by having some of these smaller venues. I don't know that I would go out and apply to have gotten a 5th or 6th, but once people have made the infrastructure investment to connect to those and they're providing value, it's something that I don't want them to become too fragmented. So right now they're at about 50 bips on BX options and 15 bips on Mercury, but they're allowing certain firms to have a reach into the specialist world, and we're constantly looking at the value of those and how they interact with our clients and making sure we're doing the right thing. So that's an ongoing discussion. So first part of my answer to your question of what we can do is pay mindful attention to fragmentation. Some of that was the box floor last year. That fragmented the market a little more. I could create more trading floors. We're reasonably good at it. We have the floor brokers, but we're trying not to do things like that because we don't think that would be a good use of our SRO licenses at this point. Competition could change that. I think that we need to work with retail and education. OIC does a wonderful job, OCC does a wonderful job, but I would like to see in this next era, as I believe we are starting to ramp up like a staircase, that we need to be even more closely aligned with the retail order flow. And by doing so, we can invest and help them with their apps. They run great apps today, but we know that the young people, the millennials, are using they're using their phones to trade. Their desktop is something that, a rotary phone to them. So I think we just need to get more involved. And with education, really. I would say if there's one answer, it would be education.
And I try to avoid every year bringing up the how many exchanges is too many question, because it's low-hanging fruit at a conference like this. But I think since you brought up exchange fragmentation, I am now legally obligated to ask you about the proposal from MIAX. Of course, they want to bring a third exchange onto their platform, bringing us to a grand total of 16 options exchanges by Q1 of 2019. I'm guessing from your comments, I can probably intuit what your thoughts are, but what are your thoughts on this latest proposed addition to the space and, in general, the increasing fragmentation of the industry?
So I'm going to answer it a little differently, and then I want to start with Box. So last year, Box wanted to open their options floor, and we made some comments that I think were very constructive, and they actually compromised and made some changes, and I think at the end of the day, that was a fairly decent outcome. From what I've seen of the MIAX proposal, I don't have enough information to truly answer it. Just the fact that they want to open another options exchange, I have 6. They have a few. I'm not in a position. I think it's disingenuous to just say I don't want more competition.
It is a bit of a pot kettle when you have 6 exchanges here.
But I will take a close look of exactly what they file and make sure that it's consistent with what we think is good market structure. But in general, I feel really confident in what we at NASDAQ provide. We're really strongly engaged with our clients. We have great technology. We believe we have great market models. So I don't really fret about the competition. I think it's for others to talk about whether the fragmentation is going to increase their cost or not. And my only comment would be I'd just like to see a little more detail and I'll opine. But competition's a good thing, and I think we're pretty good at it. So.
But you're right. It is kind of on the other end, for these market makers are already under a tremendous burden from a capital and everything else expense. And now you have yet another venue they have to connect to. Granted, it's all under the MIAX umbrella, so I'm sure they're going to make that easy for them. But still, there's risk to posting on a new venue. There's cost. Mm-hmm. So it certainly doesn't make their job any easier from that perspective. And I kind of wonder at a certain point, and how many years have we been saying this now? What is the tipping point? Is there even? Doesn't seem like there is one at this point because we keep almost doubling every few years in terms of number of exchanges. But it does seem like at a certain point, the burden imposed by a new venue versus whatever sub 1 or 2% share it's going to generate. Maybe the industry as a whole needs to weigh that, the benefits versus the impacts that we're seeing in the space. And one of the impacts we see too from the increased fragmentation, you and I have talked about this before, is just the difficulty to get some of the more complex orders executed. We even see this now in a lot of the high-end retail that are floating around and listening to some of our active retail shows. That even they're trying to do their 10-lot multi-leg spreads, and you know how these spread books work. So we know we have maybe one leg is lining up on a spread book here, and your order is actually in spread book B at a different exchange group, and the two don't talk to each other. What can we do, I think, as an industry to maybe facilitate that process? I know the exchanges have no interest in really routing orders away. They want to get those things filled internally. So is this more of a issue where the third-party vendors really can step up from a tech perspective and effectively make the spread books talk to each other? Or is it maybe something where, and I hate to say it, but is it something that maybe would require regulation down the road to say, hey, everyone should play nicely with each other from a spread book perspective?
So great, deep question. I think that's
why I get the big bucks.
That's right, and it's key, right, to the quality of our markets. We've had conversations with clients recently about what we can do there. I don't mind routing for clients to get them filled. At the end of the day, everybody wants to get filled. And if it's an extra penny or two here, and you provide a better service, you're going to see more order flow anyway. So the problem with routing is the risk that you would take as when you route out and you miss something. Again, as a former trader, I can handle that risk. I know how to mitigate that risk. I know that we'll win half the time, we'll lose half the time, and we could factor that in. I think the regulation side of it would have an issue with taking positions. So I think it's a bit of a non-starter if you think about it just from a very high level of, hey, we'll do that for you. I know that there are a few agency brokers that feel that that is their responsibility and that can differentiate them from their competition. So they have said to us, like, we'll solve this. Now that you bring it up, and I haven't heard maybe in the last few weeks, it'll be interesting at this conference to talk to clients and see, do you need me to get involved? How big of a problem? Have we made any progress in the last 2-3 years? Because this has been going on. It was really bad. I know it was really bad 3 years ago. Mm-hmm. I'm not sure exactly where we are on that spectrum of how much it's improved. But I think it's one of the key questions we should probably try to get out of this conference, for my own personal benefit at NASDAQ, but also as an industry, because that's what will keep people coming back. That's the growth, right? Complex orders are where there's some growth. It enables you to trade those high notional value, whether it's our NDX product or whether it's Amazon or any of the other high notional value stocks, that complex is the way to trade them.
Yeah, it's funny because we raise up this whole crowd of active retail. We teach them how to trade. They learn how to trade, and they're doing the right things. They're progressing from trading single leg things where they're used to hitting a bid and lifting an offer and getting reasonably filled pretty quickly, and then they progress to simple spreads, and all of a sudden they encounter these roadblocks. And,
Sure.
We don't want to put those roadblocks in their way. So certainly having 6 exchanges under one umbrella where the technology talks to each other pretty readily, that probably could go a long way towards solving, at least on the NASDAQ family of exchanges, routing amongst each other where the spread books line up. That could certainly help. So that's one of the benefits maybe of having so many exchanges under one umbrella. That could certainly facilitate that conversation. But you're right, it is an interesting one. It does seem to have mitigated somewhat. We don't get hit up as many times as we used to about this issue. Maybe they're just inured to it by now. That could be some of it, or it could be some of the exchange groups coming together maybe has mitigated that as well. But we talked to a lot of the vendors and consolidators to get their opinions on it. Some of them, you're right, are willing to take the delta risk by legging that stuff out. But it still is interesting to watch the evolution of that space. And I think we probably could all do maybe a little bit better on that front. One of the questions I have for you, Kevin, we get this a lot. In fact, we just started getting it again very recently, which is kind of interesting. We get a lot of questions of late about NASDAQ getting into the volatility space. I'm not sure why all of a sudden they're starting to ask us this again, but I thought I'd put it to you. I know when you guys picked up the ISC, you inherited their legacy volatility product, which I believe was the Valdex SKUDEX product, which was effectively VIX without the SKU. I'm not sure. Give us an update on that. Maybe we could start there. Is that still in active development? Or if not, what are you guys working on, if anything, in the vol space?
So I know certain elements of that are public because of our acquisition of ISE, and certain aren't. So I'll try to talk about it at a high level, but I'll try to answer your question. So we think that space is ripe for competition. We're well aware of the challenges in that space, from some of our competitors that have had, and that we would have the similar types of challenges. So I'm not here to throw stones at our competitors. I just think it's a great space. It's shown that there's interest there, and we are taking it very seriously. And I would expect that, if we can solve some of the challenges that we don't even have because we're not live, that you'll see something good come out of that. I can't really say a whole lot more than that, except that it's not something that we've swept away. We're looking at it very closely, and we're excited about it.
Maybe I can bring you down the rabbit hole a little bit.
All right,
we'll
good,
see.
good.
I know in the past, talking to the ISE back in the day, one of the issues was particularly with the Valdex SKUDEX. I'm not sure about any other products you may have developed since then. But I know one of the issues with that was an underline. Whether there should be a future or an ETF, and
yes,
all the issues commensurate with that. So is that maybe still something you guys are working on over there with that product? Or
I would say it's really good news that I'm now in charge of our futures platform, and that we are. If something like that were to come out, we are in a great position to execute on that, and I think we're really close.
Yes, NASDAQ having some futures facility could help with that. So that's great. Just for selfishly, I don't mind talking about VIX. Everyone likes VIX, but selfishly, it'd be nice to have a few other products to talk about in the spectrum as well. So do it for me, Kevin, if for no one else.
All right, good. Like I said, look, competition is good. It's good when somebody's competing with us, and it's good when we're competing with others. And I think it's good. We're all very competitive people in this industry. And
some might argue that a product sans SKU might have a certain level of interest right now, given
yes,
all the hubbub, or shall we say, around the VIX and the SKU itself. So just me and you talking here, Kevin. No one's listening. Maybe it's an interesting time to step on the gas a little bit.
It
in that space.
Perfect time, right?
The other space I think I'm legally obligated to ask you about is, of course, crypto. We get hit up. Doesn't matter what show, who we're talking to, what audience, advisors, basic retail, professionals, I don't care. They all want to know about crypto. So I know NASDAQ's announced a few forays in that space. Everyone's waiting for crypto options. It seems like everyone launched the futures, then they kind of backed off on the options. What can we expect from you guys in the crypto space coming down the road?
So we're spending a lot of time internally looking at it, and I think that we've heard our CEO, Adina Friedman, address it various times, and we're taking it extremely seriously, but we want to do it right. We're not going to rush, and it's certainly something we're very interested in, and I do think that eventually we'll do it, but we hopefully will do it in a way that brings real value to the market. There's just, as you know, there's so many issues. There's the clearing side of it. There's whether we want to be just in the future space and have a cash-settled future, or whether we want to do something a little more intricate. But we have our top people internally, not me, very, very smart people, working on it. And you'll definitely hear more from us on that, I would say, in the relatively near future. Not next week, but not 3 years from now either.
And it has been fascinating to watch, the evolution of the interest in this space because, a year ago everyone was at this conference kind of saying, how do we get retail interested again? How do we get, that trend I mentioned before of the 19 products is not looking good, and all of a sudden this product category kind of falls in everyone's lap that people seem to have a genuine interest in. So just from a selfish perspective, it is kind of nice that people genuinely interested in something. If we can transition that into the derivative space and away from some of these other, shall we say, quasi-exchanges, I think that would be a good thing. Well, Kevin, we kind of covered a lot of ground here. Certainly, I think a more optimistic event so far. It only just started, but certainly a more optimistic outlook than it was. One more thing I have to ask you, actually, by our listeners will get mad at me if I don't. The second thing they mentioned in our Twitter poll there, one of their biggest things they wanted us to discuss this is kind of a recurring refrain every year. They want us to ask this, but particularly this time of year, earnings season, they seem to get a little antsy about after hours for options. A lot of them seem to want it. They'll come out, they'll buy the proverbial call on Google. It moves 80 handles in the after hours, opens up UNCH the next day, and then they inevitably write to me. I don't know why, but they write to me with expressing their discontent on that issue. So, Kevin, what are your thoughts on the potential for that? Is it something that's just a non-starter, or do you think we're making some inroads there?
I think if you do check with your search engine optimizer and figure out who sent those responses, you'll find that I think I probably maybe sent 100 of those.
Is it all you? There we go.
I
did say at NASDAQ.com.
I want to trade 24 hours a day, right? So, I think we have a great product. Now, 24 hours a day is a non-starter in options because, again, it's about our liquidity. But I do think, and this goes back to one of the other answers I gave you, Mark, about working closely with retail and educating, but not just educating retail clients. They need to educate us about these types of things and what's important. But it drives me crazy that Apple will trade till 8 o'clock at night on a night that they have earnings, and we're not trading a single option. And people may have owned options and said, I just want to get out. So I think that I would love to see us do it. Maybe there's a way to do it very targeted. Maybe you only do Apple after hours for the 2 weeks, the week before earnings and the week after earnings. Maybe it's 2 days. I think there's a huge opportunity. I don't think one exchange can do it by themselves, but somebody would probably have to take the lead on it. It's an opportunity for growth. Maybe we pick up 1 million or 2 or 3 million options a day, and all of a sudden, we all know it's exponential. The more options you trade, the more you need to hedge, and the more you hedge, the more you trade. So I think it's something that should not go away. I'm wholeheartedly in agreement that it is time to do something there.
I'm glad to hear you say that because every year I come down here and I ask that question. I think you're, if not the only, very, very, very few of your colleagues in the exchange world seem to share your optimism on that. But you're right, it is a shame that so much underlying goes up and yet there's not a single option contract to be found in that. I think the limited kind of pilot you laid out, maybe there is some at least trying something, right? Because something's got to be better than nothing.
We can do one symbol, right? We can do one symbol and see how it works. Now, we have to be really cognizant of the fact that the clearing firms need to be open, but a lot of these firms are trading futures anyway. They have help desk. We're staffed 24 hours a day. Our market operations team is there 24 hours a day. So we're ready. We just need to make sure our clients are ready and we don't shove something down their throat. But I think we've spoken to clients recently about this, and there's certainly more buy-in than there had been in the past. And I know that some of the retail firms definitely want it. So
yes, the retail firms definitely, because
they
get the same emails we do saying we want this. So you're right. There is a clear gulf between the retail side who clearly wants it and lot of the, shall we say, exchanges who have been more reticent. But hopefully maybe your opinion will help sway some people to come to the dark side of after hours. At the very least, maybe a pilot is in order. Well, Kevin, we kind of covered a lot of ground here: crypto, volatility, after hours, liquidity. That said, if there's anything we didn't touch on, or maybe you want to leave our listeners with a little bit of a hint, a little bit of a tease of what's coming down the pike from NASDAQ, now is the time, sir. The floor is yours.
So yeah, I don't really have much of a commercial, except that we said it during the low volatility era. We did it with our acquisition of the ISC. This industry is extremely important to us at NASDAQ. This is why Adina Friedman is on a panel tomorrow. She'll have a chat with Craig Donahue. This is why Tom Whitman's here. This is why I'm here. Our entire team is here, and we take options very seriously. We believe in it. We believe it's a huge growth opportunity. It's one of the cornerstones of the NASDAQ business, and we continue to be extremely excited about options.
Well, I'm glad to hear it. We're a little bit excited as well, hence our presence down here, and we'll look forward to seeing how all this interesting stuff, including the volatility stuff, plays out at NASDAQ in the coming months.
Thanks, Mark.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.